WIX stock, a company that I own, was demolished yesterday after it posted worse than expected Q4 2021 earnings. Actually, the full year 21 earnings weren't that bad, or the results for WIX were actually pretty good on an annual basis, but it was the Q4 earnings that got investors back up. And we're going to look at this today and think about how do we react to this 25% basically drop that we've seen in one day. It's also down 70% from where it was trading for a pretty long time last year. Right, this was a company in WIX that benefited greatly from COVID-19 and the stay-at-home economy. So it's now back down to pre-COVID levels, which is something I definitely couldn't have conceived. And unfortunately, we're there. And I say unfortunately because I do own shares in WIX, and my cost basis, which we'll get into later in the video, is around $150 per share. So yeah, I've really been hit by this drop, but we're going to think about how we should react to this drop and whether it's a buying opportunity, especially for a lot of people who haven't actually invested into WIX yet, and for people like myself, maybe Pat Dorsey and Rob Vanal, who invested at higher levels, and how they should think about where they go from here. So first of all, let's look at the Q4 results and essentially what caused the sell-off, and was the sell-off warranted? And the first thing that you need to know is that they posted revenue growth of around 16%, which obviously isn't bad on the face of it. 16% growth, especially with all the results that we've been seeing, is pretty good. But when we compare that to what the story was with WIX, right, was growing at 38% this time last year, and it's not that appealing to investors when it's a growth story. This was selling at, as you can see here, 10 times sales back in early 2021, like a lot of SaaS businesses were. But 16% growth doesn't quite mathematically work with 10 times sales, unfortunately. So 16% growth year over year. The creator subscriptions revenue, which is the core business for WIX, was up 15%, as you would probably expect. However, the surprise was in the business solutions revenue, which is payments, e-commerce, and things like that. So the transactions within the WIX operating system. That was where the surprise was, really. And we'll get into how worried we should be about that in a moment. But the other thing was that gross profit, we saw a decline in gross margins once again, driven a little bit by margin decline in both of these companies. Management put it down to investments, and that's why it's on a GAAP basis. They say that it was infrastructure building, and that's where the cost of revenue comes from. There may also be some stock-based comp in there as well, but you can see margins declined from 65% to 62%, and that meant that gross profit, actually what trickles down to the bottom line, only grew at 11% year over year. Again, we're referencing 10 times sales this was selling at in 2021, so actually when you look at that, the stock probably needed to sell off a bit. Now, the next thing was to do with guidance, and guidance on a full year basis was withdrawn due to the lack of clarity around results. And obviously this isn't something investors like to see. It usually suggests that there's going to be headwinds coming into the year ahead, and that's why they're not giving out guidance, especially if they have been happy to do so before. But what they did give was Q1 2022 guidance, and that was definitely weak. We can see here 11 to 13% growth they were guiding for Q1 2022. They put that down to obviously a COVID spike in Q1 2021, which was 41% growth year over year. They also mentioned in the investor call that those cohorts that they managed to actually acquire in Q1 21 and Q1 20 were some of the weaker cohorts in terms of their churn. So that could be a reason for it, but it's definitely not something that investors, even myself, are happy with to see that. And when you consider that WIX, with it being a SaaS model, it's recurring revenues, it's supposed to be a highly predictable business. And they boast about it being a highly predictable business. So it's a little bit confusing seeing that there, a little bit disheartening to investors. The next thing was net income on a GAAP basis. Loss was worse than expected. I'm not really concerned about that, but it's something that obviously the market and the street do look at and would sell off a stock for. The last thing, and one of the more important things when we're thinking about fundamental valuation, was free cash flow, excluding one-off investments that were made, was disclosed as around 161 million in 2021, which, all in all, for a company that hasn't been reporting a lot of profit, is quite good, 13% margin. However, that made WIX 40 times free cash flow with only teens growth guided for 2022. So the market will always haircut that, right? You know that. And it's now at 29 times free cash flow after the sell-off with that 2021 free cash flow margin. So not too bad, still a little bit expensive if you're looking at it in one dimension. However, I think we can expect that free cash flow margin will scale somewhat in the future. And so I think when we factor in all of these 5 points and relatively disappointing news and disappointing results coming out of WIX for this quarter, remember this is just one quarter. The annual results, like I say, were actually pretty good. I think it was like 25 to 30% growth year over year. But this quarter was quite disappointing. And I think maybe not warranting a sell-off from 118 to 120 where it was. But if we think about this stock was back up at $300 per share in 2021, I think it definitely needed quite a significant haircut from that, it's fair to say. But all in all, probably warranted if you consider the news and lack of visibility around WIX's story going forward. Now, I want to talk about the inside view and essentially what management said on their investor call and some of the positives that we can take out of this. Maybe not in the short term, but thinking about what we've seen and how that will affect the long term and affect the long-term valuation and return that WIX can give to shareholders. So the first thing is that business-to-business partnerships, which now makes up 20% of sales, will hopefully drive the re-acceleration in revenue going forward. This is a segment of the business that is growing at 75% year over year and obviously has a lower cost of customer acquisition just because those agencies that are partnered with WIX are the ones who are out there trying to fetch customers. So this is a really important thing for WIX. If they can keep this growth rate up at 75% and it's now 20% of sales, we're going to see some meaningful impact in the top line numbers going forward. The next thing was that, it's commonplace at the moment in Q1 21 in terms of the Q4 21 results, the e-commerce revenue growth is decelerating year over year due to the COVID spike. And we had Shopify recently report results today as well. That's down 20%. PayPal and Facebook, among others, all gave guidance that growth will taper off in 2022. And so Shopify didn't guide. They just said that growth will slow, which you can take as you will. PayPal guided around 13%, similar to WIX. Facebook guided at 3 to 11%. So I think really this is a sign of the times. And I think in all these companies, and I mention these companies because they are high quality businesses that are reliant on e-commerce transactions or e-commerce sales and the health of e-commerce. So these are all high quality businesses like I think WIX is. And I do think it is transitory, this slowdown in revenue growth because of obviously the spike we saw during COVID. And the next thing is to do with the margins of the business. And I think this is important because maybe if growth is slowing down, I was expecting sort of 20% growth for the next few years for WIX. It's looking like that could be teens if we're going by the information and data we have at the moment. So it turns more into a operating leverage scaled margin story. And so what management said on this, and by the way, when management starts to talk about prioritizing profitability, it is usually a sign that they're seeing less growth opportunities than they were previously. But anyhow, management said that they expect free cash flow to reach a 10% margin next year and exceed 20% over the long term, maybe in 24 to 25. And that suggests a free cash flow compound annual growth rate north of 40%, right? Doubling sort of every other year, attributable mainly to operating leverage and a mix of growth in volume. We could see here what they said. They said that combined with anticipated revenue growth on these new initiatives and our operating leverage, we expect free cash flow margins to reach 5% in 2022 and 8 to 10% in 2023 on a reported basis. And one thing they also mentioned in the investor call transcripts was that the core subscription business, which makes up the vast majority of revenue, it's now $1 billion in annual recurring revenue, actually had a 20 to 25% free cash flow margin in 2021, which is around $200 million plus in free cash flow. So definitely a sign that it's a healthy business from a profit perspective if we're stripping out those one-off investments. The other thing is that business services and payments, which was introduced back in, say, 2017, 2018, definitely needs time to scale and leverage their infrastructure spend. They've been spending a lot of money on trying to transform WIX into an operating system rather than just web development and a website builder. And that has cost them a lot of money in incremental dollars as well. So they've been incrementally investing back into the business, which has driven down the reported free cash flow. So that should help stabilize gross margins, maybe even scale them, and also increase group reported free cash flow. And I put down here just what management did actually say in the transcripts, because I think this is important to think about where the business can go and where management see it going. And they say that they expect in the future at some point, or in the near future, that they will reach the same level of free cash flow that they've seen before, and believe that they're actually going to exceed that. And what they mean by the same level of free cash flow is in 2017 to 2019, they had roughly 17 to 20% free cash flow margin. So CEO thinks they can actually exceed that in the near future, which is something that I believe they can do as well. Like I've covered in previous analysis with WIX, if you look at the company on an underlying basis and strip out some of the growth spending, they are very profitable. There's like a 25 to 30% free cash flow margin there at scale. And so putting all of these changes together, and I've done an IRR calculation here, distribution of IRRs based on cost basis and based on performance. But what I have done, the main thing that you probably need to consider here is I've put the base case down to 15% revenue growth on a 5-year basis. They actually think that growth will re-accelerate from this teens rate once we get out of the COVID spike period. So there's some upside left in that if the deceleration is transitory. Free cash flow margins to reach 20% by 2026. As you can see here, it might be a little bit small. We're starting at 5%, getting to 10%, 15%, and then 20% for the final year. So it could exceed 20% by 2026, and that's what I've got here in this best case scenario, really. As you can see, but I'm going to go with 20% for the base case just to try and put some conservativeness in there. Now, the distribution of IRRs, like you can probably see, is quite favourable, especially from today's price. So if you're someone who hasn't got into WIX yet, it looks like a very good opportunity. We'll just run through it. On the base case, 15% revenue growth with 20% margins. You're looking at a 23% IRR. On a cost basis, where I was at, which is around 150, my IRR looks around 10%, right, based off of these depleted assumptions. A better case is with 25% margins off of my cost basis. It indicates around 19% as an IRR on a 5-year basis. And then as a better case with that 25% margin on the new cost basis, which is where the stock has sunk to now, you're looking at an IRR of around 34%. So if I'm looking at that objectively, and I think these are quite conservative assumptions, I think growth will re-accelerate, and I think this margin target will be hit in the future. So the distribution of likely outcomes indicates a 23 to 34% IRR from today's price and a 10 to 19% IRR from my unfortunate cost basis, which was bought back in January. So all in all, I will be holding, maybe adding more to the position if the story develops more favorably. I'm just going to wait this one out for now because I bought a position sort of 5% of the portfolio, so it's fully sized at the moment. But definitely, if you're not in WIX at the moment, it's looking quite attractive from a hypothetical perspective and an IRR point of view with some conservative estimates. So just wanted to hop on here and talk about the latest drop, because obviously it's a stock that I own. It's a stock I've done analysis on before. If you are interested in WIX and knowing more, then you can look at the 2 previous videos I've done on WIX. I'll leave a link in the description, and that should give you an idea of exactly what the business does and why I see these assumptions as being conservative. Apart from that, if you want access to the IRRs that I've done here, the IRR distribution, and obviously my valuation models on WIX, where you can see how I've modeled out all of the assumptions and what the fair value gets to, I will leave a link down to the Patreon below, and you can go and check that out over there. You get access to all of my valuation models. You also get access to exclusive analysis and updates, my buys and sells, my write-ups, which we have one on Spotify coming fairly soon at the end of this month, and you also get access to the Discord community. So if you're interested in supporting the channel, go ahead and check that out. I'll leave a link in the description. But apart from that, let me know your thoughts on the latest drop for WIX in the comments below. Leave a like if you enjoyed the video. I'll see you all in the next video. I actually have one planned to come out fairly soon as well, one that I had planned for today, but the drop in WIX ensured that I had to get this video out. But until next time, good luck with all of your investments, and I'll see you in the next video.